With U.S. stocks back at all-time highs, the question is, can the Fed deliver, and can trade negotiations between Trump and Xi Jinping continue to build momentum? After suffering their first monthly loss of 2019, U.S. stocks rallied all the way back to all-time highs as the Fed came out and signaled they're likely to cut interest rates before the end of the year. And also, investors looked forward to the G20 meeting at the end of the month for hopes that President Trump and Xi Jinping could resume trade negotiations. Foreign stocks also posted gains during the month for similar reasons. Additionally, global central banks, most notably the European Central Bank, signaled increased monetary accommodation is likely before the end of the year, specifically rate cuts and potentially asset purchases. Interest rates fell during the month of June, sending bond prices higher, as bond investors believe that not only the Fed will cut interest rates at their July FOMC meeting, but potentially cut rates 3 more times over the next 12 months. That sent the 10-year Treasury note and the 30-year mortgage rate down to their lowest levels since Trump was elected president. Going forward, the big questions for markets are, can the Fed continue to boost stocks? And can Trump and Xi continue to make progress on trade negotiations? We think the Fed and earnings are going to be the primary drivers of the U.S. equity and interest rate markets during July. Expectations are very high for the Fed to cut rates during July and signal further rate cuts. If the Fed comes out and signals fewer rate cuts in the future than the market is expecting, or potentially doesn't cut in July, that could definitely have a negative impact on stocks, with a pullback of anywhere from 5 to 10% in our view. While enthusiasm that Trump and Xi Jinping might reach a trade deal has definitely supported markets thus far, the negative impact of prolonged negotiations and the escalation of tariffs that we've seen is starting to have negative impact on the earnings picture for U.S. companies. For example, Q2 earnings are expected to come in with negative year-over-year growth, similarly for Q3, and 2019 calendar year and 2020 calendar year earnings expectations continue to be revised down. Q2 earnings season kicks off mid-month, and so we'll be watching that very closely.